No state or city will be spared. That's the information we're getting right now, as new data is showing that the level of people sick in Detroit and New Orleans is off the chart and might be even worse than New York City. And with that information and with this sickness spreading all throughout the country, of course, there's going to be major economic ramifications, which could be even more severe than this illness all across the world. And to talk about this, plus a lot more, we have John Sneisen, who's a financial historian, and of course, our always co-host of the day, Tim Pichette, a financial planner. I'm Luke Rudowski of We Are Change, a financial novice, if we're going to go off by titles here. And guys, there's so much news to get into. There's so many things to talk about, especially with the IMF declaring that we are in a global recession. The Fed deciding that they're going to be buying ETFs, deciding that they might even double their balance sheet this year. I mean, what's some of the craziest news you guys see that really is the most eye-opening, since all of it is, but what's the first thing that really comes to you that is most eye-opening to you?
Yeah,
let's go off. Yeah, go ahead.
Yeah, I'll kick it off. And thanks, Luke. I mean, for me, it has to be the fact that the Fed is going to start buying ETFs. I mean, that's just an incredible thing. And so probably first off, what would make sense to do is if we actually explain what an ETF is. So an ETF stands for Exchange Traded Fund. And essentially what that means, instead of buying, picking out, Apple stock, and it's not financial advice, it's using it as an example, or GM or whatever, you buy maybe all large cap stocks at once. Or in this case, it's bonds. So these are actually bond ETFs. So instead of saying, hey, we're going to go pick, General Motors bonds or Ford bonds or Elon Musk, bonds over at Tesla, we're just going to go buy, instead we're going to take one of these funds and we're going to start buying up the bonds from the funds. So essentially what is going on is that instead of having true free market price discovery, you're having companies getting essentially bailed out, or investors and hedge funds and pension funds getting bailed out. So they're able to offload, for lack of a better word, their crap that they wouldn't be able to sell, especially in a panic sell. They're able to then offload that to the Federal Reserve. And so now the Federal Reserve is buying these assets for 100 cents on the dollar. And of course, it's the people who are going to end up getting screwed throughout all this. So if we go on in the article for Market Watch over here, it says the Fed is going to buy ETFs. What does that mean? And on Monday, the Federal Reserve announced a fresh round of stimulus designed to calm markets and buffer the hit to the economy from the coronavirus pandemic. Among other steps, the Fed said it would buy exchange-traded funds that track the corporate bond market, a first for the central bank. This will provide much-needed liquidity to the bond market and to ETFs, said Ted Rosenbluth. Investors across all kinds of markets are racing to sell everything. And, they're going on to say how great this is, and this is, a great thing to do. But another quote here is, all of this is to make sure the people who want to sell have a buyer. Well, guess what? For the certain price, everybody should be able to have a buyer. I mean, it's just absolutely ridiculous what's going on. And John, we may have lost your camera, so if you want to go and try to get that back on while we kick it off to you soon. But in large part, the Fed is using ETFs to accomplish this goal because it's harder to buy individual bonds than stock positions. Oh yeah, so difficult. So we're just going to go in and provide this for everybody. ETFs offer the benefit of impacting thousands of bonds in one trade. For example, as previously reported, the big investment grade corporate bond fund, iShares iBox investment grade corporate bond fund, ticker symbol LQD. Again, I'm just mentioning this because it's part of the article, not financial advice. Closed on one particular volatile day, down 5% lower than the day it started. That means anyone who tried to sell LQD on Thursday received about 95% of what they might have expected. A powerful market stabilizer like the central bank may help buffer those strains. Now, John, I want to kick it off to you because, that's just such an incredible statement that, instead of, oh, this is such a great thing for the markets. Well, what it's doing is this is not a market anymore. We have just killed the markets. This is going into fascism. And what do you make of this article?
Well, this is just pure blatant fascism and communism, where the central bank, I wrote an article 3 years ago that stated that the Fed will own everything, then nothing, and here we go. They basically are following the same sentiment of what the Bank of Japan is doing, where they bought 86% plus of the ETFs that are out there.
That's it.
They bought stocks, bonds, mutual funds, real estate. They basically tried to buy up anything that loses value to keep it up from losing value, so you don't get a panic and a massive deflationary sell-off. That's what they're trying to do. But It's interesting. We were talking about that they could double their balance sheet by the end of the year. Well, if they continue just on the trajectory that they have now with $120 billion spot, and this is not even talking about the corporate bonds because they haven't announced it yet, or they haven't started yet officially on their website. But the numbers currently are about $120 billion a day that they're buying mortgage-backed securities and treasuries. And if you were to run that out the year,
now we've got your website pulled up, John. So which chart is that going to be underneath? So we got there's 10 different graphs.
10. So if you go to like the last one,
we got it.
We got it. Yeah. So if you were to actually add up the $120 billion a day that they're currently doing, if they kept on that trajectory throughout the year, they will add on from now on until the end of December, $21.6 trillion to the balance sheet. So we're not even looking at a doubling. What is that? That's almost like a sixfold amount. Like I would say probably 5 times plus. The add-on to the balance sheet. So basically, what you're going to see this continue. They're going to have to get into the market and intervene because they don't want deflationary pressures, because deflation is the enemy of today's modern monetary system. They need that constant inflation, because when you create money out of thin air, there's always more interest that you owe on that than there's actual physical money in the world. So you'll always be in a lack of interest. And if you paid everything off and even bought everything, you would still owe interest on that debt. So it's a Ponzi scheme that is meant to fall apart, and that's why you're going to see the Fed is going to start buying stocks. They're going to start buying, directly just ETFs, mutual funds. They're going to buy real estate probably. Who knows what they're going to get into to try to, end basically there's zero
MLN marketing schemes. Yeah. They're probably going to be selling essential oils soon on Instagram, like with all the other single mothers out there. Sorry, go ahead, John. If you have finished, I got some other points I want to make here.
Yeah, no, that's basically what I had to say. But it's just insane, guys. We're in a period of time where, actually, it's not insane, because any central banking entity throughout history has, started to entail on this scheme of Ponzi and interest and all this stuff. Always fails throughout history. So it's nothing new to that. We're going down the lane and are desperate and trying to save the economy. But we're gonna fail miserably, even though we have electronic currency today and all this fancy.
Especially since we have all this fancy, currencies, and we did a video the other day on how they're calling for, we want to have a digital dollar, and here we got an article: the IMF declares global recession and doubles the size of its financial war chest, and then we've got Goldman Sachs clients are asking
SDR bailout coming.
Yep, SDR.
Before we get into that, last time we shot this video, we kind of made fun that we're living in communism. We called John Red Lips, we called Tim Gulag Pashtet, we called me Rutsky and all that. But really looking at it, it is kind of, as you mentioned, John, earlier, more of a kind of a fascistic economic system, right, where we have the federal government intervening and pumping up all these supposed kind of quasi-corporate private entities that are going in there. And it's absolutely a joke. There's another article here by CNBC that talks about how the traditional retirement portfolios of stocks and bonds are down 20%. This is the only fourth time that this happened since World War II. And this is major because, again, this is akin to just the utter corruption that's happening right now. There was a recent press conference by the Attorney General and the FBI talking about how they're going after price gougers. We're going after all the bad people who bought off supplies for $1 and they're selling them for $1.25 or $1.50 to make a profit because they're in short supply. We're going to go after all of those guys. And that's an absolute joke compared to the actual criminality happening right now in front of our very freaking eyes. There was even a police department sending a photo. You know how they used to do those photos that when they had their drugs, a little bit of drugs, a little bit of money, and they stand there proudly like they're doing something good for the war on drugs. Meanwhile, they're making it that much worse. I saw another local police department have a couple stacks of toilet paper, some hand sanitizers on a desk that wasn't bigger than this, and they're standing there proudly like, we got the price gougers. I'm like, do you see what else is happening on Wall Street? You god darn stupid, idiotic little buffoons. I mean, you got to be freaking kidding me. Look at Amazon. Jeff Bezos, of course, sold a lot of his stock before the major crash. Look at all the U.S. senators that were in hearings, knew that the storm was coming, sold a lot of their stocks. And now, people's retirements, people's, rainy day funds that were illegitimately taken and treated irresponsibly, well, they're going to lose out on it more than anyone else. And then we're just going to be just giving out money like it's crazy.
I'd really like to touch on that one, the one topic, especially of the retirement. So we can pull this up on screen right now. And so the reason I want to talk about this is traditional retirement portfolio of stocks and bonds is down 20%. Now, what typically, there's something called modern portfolio theory, where it's, you diversify your assets across all these different assets. And then there's some that aren't correlated with each other. But what we saw in 2008 is that everything was essentially correlated with each other. So you saw all the assets basically go down at once. Now, then things were a little bit different because you could actually get paid having bonds. And so let's say, you could get paid, 6 or 7% in a bond back then. And then when the rates went down, you actually made money when the price of the bond went decreased in value, because your bond that was paying 6% is now going to be worth a lot more when everyone else can only get a bond that's paying 2%. So, you'd rather get 6 than 2, so there's going to be a premium. Well, now that we're already in the basement, there's nowhere for this to run. And so that's why we had over at Innovative Advisory Group. So my moniker is Deliberate Advisor, but the company I'm with is Innovative Advisory Group. And we think modern portfolio theory is dead. And so we had a different strategy where we were able to, essentially our clients were only down 5%, fully invested into the market during all this based upon a strategy that we're running, but it also worked out the year before. Now, I did a video about a little over a year ago, I think it was January of I forgot what year we're in now, 2019, with Tom Hegna, who's probably widely considered probably one of the top retirement gurus in the country. Like if you want to go, have him speak at your event, it's like $15,000. Anyways, we went and we interviewed him last year, and we talked about I think the video was actually called "Why Rates Are Staying Low Forever," and we got into all these different issues. But effectively, in that video, we were talking about how the 60-40 portfolio was dead. There's other ways that you can do this. So if you have 40% of your portfolio in bonds, and that's what 60-40 means, 60% stock, 40% bonds. If you have 40% in bonds, I had ways where I thought there was much better solutions where you could have 40% in another asset class. I'm not talking about gold or silver or Bitcoin. There's other income producing asset classes that, will give you more income, more stability, and even more upside. It's all contained in that video. So, that was, it was one of the first times I've ever interviewed anybody. So I did talk way too much, just like I'm talking way too much right now. But, I think that was, provides, pretty much the roadmap. Now there's another video that I shot where it shows that if someone were to take, it's redesigning the 60-40 portfolio. So instead of having 60% stock, you would have 58% stock, 2% Bitcoin, and then 40% bonds. Now, I don't think it would be a good idea to have anything in bonds, but what it showed is you actually, by having more risk in your portfolio, because Bitcoin wasn't correlated, that your returns, it actually decreased the amount of risk in your portfolio. So so you can actually throw in riskier things. Now there's a limit to this, and then decrease the risk because as certain assets aren't correlated with each other. Very advanced concept. Sorry, Luke.
How are we doing on time right now? Because I want to throw it to a bigger kind of segue.
13 minutes.
All right, let's continue this conversation in the second video, where we're going to be discussing if the economy will restart. Steve Mnuchin just said that we're going to be recovered. Everything's going to be fine again. He said we're not going to have a recession too a couple of days ago. The New York Times just wrote an article, "Can we safely restart the economy in June? Here's how." Again, a lot of insanity. We're going to talk about that in the next video. Stay tuned here on Change the News channel.